Hey everyone, it is Julie here with TipRanks, and today we're taking a look at a couple of the best rated stocks in the past week. So let's get into it. Alright guys, welcome back. Happy Monday. Thank you all so much for being here. Today we're taking a look at TipRanks Trending Stocks, specifically some of the best rated stocks within the past 7 days. These companies have been picking up a lot of recent attention from Wall Street analysts, so we're going to take a look at them, what's been going on with them lately, and of course what those Wall Street analysts are predicting for the stock's future. We found these over on the TipRanks Trending Stocks page. Found right underneath research tools with trending stocks, you can look by analysts, followers, or unusual volume, looking for the best, worst, or most rated in the last 3 days, 7 days, or 30 days. Commonly at the top of the list, we have some of the big Magnificent 7 tech stocks, but we went a little bit further down the list today. Just before we get into our 2 trending stocks, this is a reminder that if you enjoy today's video, make sure you hit that thumbs up button and that you're subscribed to the channel. You can check out the trending stocks over on the TipRanks website or by downloading the TipRanks mobile app on your Android or Apple device. Links are in the description down below. Let's get right into our 2 best rated stocks. First up, we're taking a look at a company called Stryker. They trade under the ticker SYK, currently priced at $365 per share. Year to date, their stock has climbed about 22.5%, and in the last 3 months is up 15.5%. They do currently score a 10 out of 10 on the TipRanks Smart Score. Stryker is a global medical technology company providing surgical, medical, and orthopedic products and services. Their goal is to help healthcare professionals work more efficiently and enhance patient care. They serve a variety of healthcare customers, including hospital administrators, surgeons, and healthcare professionals. Some of their products and services include implants for joint replacement and trauma surgeries, neurosurgical and neurovascular devices, a PCD and spinal device, and surgical navigation systems with endoscopic and communication systems, plus patient handling equipment. Their products can be found in 75 countries around the globe, and they impact more than 150 million patients annually. The company has completed multiple acquisitions in recent months, including Virtus Medical. They provide a minimally invasive solution for treating chronic lower back pain caused by lumbar spinal stenosis. They also recently agreed to acquire Care AI, which specializes in delivering AI-assisted virtual care workflows, smart room technology, and ambient intelligence solutions. The stock has been trending with Wall Street analysts as they did just share their Q3 earnings report last week, where they had both an earnings and revenue beat. They reported Q3 earnings per share of $2.87, beating expectations by 10 cents per share. Revenue came in at $5.5 billion, which did increase 12% year over year, beating expectations by $130 million. They also saw their organic net sales increase 11.5%. Looking forward, the company is now anticipating full-year organic net sales growth to be in the range of 9.5% to 10%, and they said with a strong first 9 months of the year and strong momentum going into the fourth quarter, they increased their adjusted earnings per share to be in the range of $12 to $12.10. Following that earnings report, we have had several analysts increasing their price targets on the stock, including a couple of 5-star analysts from both Barclays and Argus Research. Argus increased their price target to $410, saying that they delivered strong operating results through solid execution and robust demand for their Mako robotic surgical system for orthopedic procedures, with Mako driving market share gains for Stryker. They're also strengthening their market position through mergers and acquisitions and new product launches. Barclays also increased their price target, noting the impressive beat, double-digit growth across most major businesses, and upsides to operating margins. The Stryker stock has 19 current analyst ratings, coming in as a strong buy with 15 buy ratings and 4 holds. The average price target comes in at $380, which would just be an upside of over 4%, but we do have a few older price targets dragging that down. When we look at all of our newer ratings here just from last week, a lot of them around 10% or higher. Our high-end price target is $420 from JP Morgan for an upside of 15%, while our low-end is a hold rating with a slight upside of 1.3%, and then further back we do have a couple downsides from the end of the summer. And our second best-rated stock today is MasterCard. They trade under the ticker MA, priced at $503 per share. They've climbed nearly 19% year to date, and in the last 3 months have gained 14%. They do score a 9 out of 10 on the TipRanks Smart Score. MasterCard, of course, is one of the well-known names in the global payment network industry. For more than 50 years, MasterCard has helped authorize, clear, and settle transactions between financial institutions and businesses, offering plenty of branded debit, credit, and prepaid cards. The company serves everybody from individuals to small and medium businesses to governments and large enterprises. They're now moving more towards the digital world with different online solutions, including digital identity verification, anti-fraud systems, and supply chain financing. They also just shared a Q3 earnings and revenue beat at the end of October as they saw cross-border volumes rise. Their Q3 earnings per share came in at $3.89, beating expectations by 15 cents per share, while revenue came in at $7.37 billion, which did increase 13% year over year, beating expectations by $100 million. The company did see that cross-border volume grow 17%, and management noted that their strong performance this quarter highlights how we're delivering across all aspects of our business. These results reflect healthy consumer spending and ongoing solid demand for our value-add services and solutions. Of course, following that earnings report, plenty of Wall Street analysts weighing in, including a couple of five-star analysts from both Morgan Stanley and Macquarie. Morgan Stanley noted that spend patterns are healthy through October and international travel growth can still be a source of modest upsides. They did note that fiscal 2025 has nuances around lapping client wins and a higher tax rate, which did result in the firm's fiscal 2025 earnings per share estimate coming down as it recalibrates taxes. The analyst at Macquarie said that they delivered a Q3 beat on revenue and still expect growth for the full year, while the Q4 data is solid and U.S. business is benefiting from some timing impacts. They added that their preference in the space remains MasterCard, largely because of its mix being exposed to higher growth internationally, though it's also doing better than its peers domestically. With 16 current analyst ratings, the MasterCard stock does come in as a strong buy, with 13 buys and 3 holds. And the average price target of $544 implies an upside potential of over 8%. Looking at some of those more recent ratings here, our low-end price target is our hold at $509 for an upside of just 1%. This was pre-earnings report back in September, while our high-end does come in at $605 for an upside of over 20%. So that is a quick look at 2 strong buy stocks that are among some of the best rated stocks this past week. Let me know your thoughts on these companies in the comments down below. I always appreciate hearing from you guys. Keep in mind these videos are never a suggestion to buy or sell any specific stock, just sharing what those Wall Street analysts are up to, so please make sure you always stick to your own investment plan. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.